This video will discuss market efficiency. We'll discuss market efficiency in the debate between active and passive investing. We'll define what is meant by market efficiency, and we'll discuss what is meant by beating the market. We'll define and discuss three forms or levels of market efficiency: the weak form, the semi-strong form, and the strong form. We'll define and discuss the random walk hypothesis and compare it to these three forms. We'll discuss market anomalies, and finally, we'll provide questions to ask professional portfolio managers who claim to be able to beat the market and have evidence to prove it. This is a fascinating chapter. It requires almost no math, but the material is extremely deep. It's a fascinating topic. So with that in mind, let's look at market efficiency and the issues involved in beating the market. So let's start off defining market efficiency in the world of finance. An efficient market is a market where stock prices, for example, it could be bond prices too, but let's think mainly in stock prices in this chapter. Stock prices reflect all information that's out there in the economy. So all relevant information is embedded, or what people on Wall Street often say, baked in to the price. So if you see a price for $43 for a stock, for example, that $43 reflects all patterns and things that happened in the past, information that was released in the past about the stock, and then people's expectations about the future for the stock. So expected earnings, what the Fed is going to do, what the Treasury is going to do, exchange rates, things related to the market structure of the industry. All of that is baked in. That's what we mean by market efficiency. Now, it's important to realize that there's a lot of implications to this. If the market's efficient, prices are already reflecting everything, all information, then if you are an investor, an active investor, and you claim to be able to beat the market, the question is, what information do you have that gives you the ability to beat the market? What's not baked into the price? And active investors are going to tell you, well, I don't believe in market efficiency, that prices do not actually behave according to market efficiency. They're not, all information is not quite baked in. I happen to have the secret recipe, the secret information. So, I think the stock market is, or this particular stock is undervalued at this point because it doesn't reflect what the Fed is going to do next meeting. Or I think that the market has incorporated or is expecting too much from the Federal Reserve or the federal government coming up in the future. The market has it wrong. So basically you have individual investors who are saying, look, the entire market, which is setting that price at $43 for a particular stock, or even the S&P 500, they have it wrong. I got it right, is what they're saying. Now, there's a lot of evidence against that idea. We're going to talk about that. There's a lot of evidence for that idea. And so we're going to look at the debate that goes on. Over the past decade or so, there's been a lot of evidence to lean towards market efficiency, and that has supported the idea of passive investing. So if you've noticed and take a look at the volume of passive investing, people that are trying to just match the market through indexing, for example, and buy and hold strategies, that percentage of the market is huge now. It's grown tremendously, and people are slowly moving away from active management. Now, that doesn't mean active management's dead. It's strong and alive. There is some benefit to active management. There is, in fact, active management is what keeps stock prices appropriately priced. So if you have people that are out there roaming the market looking for undervalued stocks because information is not quite embedded in there correctly, then they're going to push the price up to its fundamental value and then keep the market efficient. So we need active investors. We got plenty of them, but like I said, the market is leaning now in the past 10 years towards passive investing and index investing, which is just an example of passive investing. Now, that said, let's define what we mean by beating the market. So that's what's really deep about this topic, is what does beating the market mean? Let me show you. Let me give you an example, because beating the market means you're beating the market on a risk-adjusted basis, or you're considering or reflecting risk. And let me tell you why you have to consider risk. In fact, you should already know that by now. But I'll cover it anyway. So here we have beta. This is a measure of systemic risk. This is the expected return on the stock. This is also K, the required rate of return on the stock. It's the discount rate that we've been working with. It's this, risk-free rate plus beta times the expected return on the market minus the risk-free rate, where this is the market risk premium. So you basically had a line that's called the security market line. This is the risk-free rate, zero risk. You earn the risk-free rate, and then you earn a risk premium for anything higher, any more risk than zero. And you're up along this line. Now, if you look at the stock market as a whole, the stock market as a whole has a beta of 1. And so we'd put a beta of 1 right here. And let's just say interest rates, the risk-free rate, the T-bill rate is 1% for ease. It's a little less than that in today's world. And then we would say, well, maybe an expected return on the market in today's world would be 10%. So this would be a market risk premium of 9 plus 1. That would give us an expected return on the market of 10%. Come up, come over, and we get 10%. Now, if you pick an average stock, a stock with a beta of 1, then you would expect a 10% return given this model here, the capital asset pricing model that we're working with. Now, if you pick a stock that has more risk or a portfolio has more risk, say up here, then obviously you would expect a higher rate of return than 10%. And if you took lower risk, if you had risk less than 1, less than the market, a beta less than 1, you'd come up and something less than 10%. So the first thing you got to realize is people tell you, well, I can beat the market. Well, if they've taken more risk, well, obviously you expect them to beat the market. See that little E? You would expect them to beat the market because they took more risk. Or if they took less risk, well, of course they would be, on average, have returns lower than the market. And so that's expected. So the point is, we're going to come across people that have portfolios, or let's just say we have a portfolio right here. We have a portfolio has a return. Let's just say it has a return of 14%. Making numbers up here, come down. Let's just say this is beta of 1.2 right here. What this is saying is, look, this stock has what's called an abnormal return of the difference between 14% and whatever this return should be, given that we plug in a beta of 1.2 here. So we plug in a beta of 1.2. With a beta of 1.2, we'd get an expected return of 11.8%. So this should be 11.8%. And so right here, this difference here, this difference is our abnormal return. And that abnormal return is 2.2%. That's what we mean by an abnormal return. It's not comparing this return here of 14% to the return of the market at 10%. You can't go back and forth this way. You got to look at things for a given level of risk. What should the return be, and what is the return that you're expecting? It's got to be that way. You can't move in a lateral direction this way. And by the way, this is related to the concept of alpha. So this abnormal return is basically an alpha. And what we mean by alpha is, let's take this formula right here. Bring it down here below. So we have K, our discount rate, is a risk-free rate plus beta times the expected return on the market minus the risk-free rate. Okay, that is the discount rate, or this is the required rate of return given the risk. There it is. There's the risk beta. That's what we were using here. Now, if we rearrange this, we could just take K, which is the required rate of return, minus the risk-free rate. That is the risk premium on the stock. This is how much return you expect to get over and above the risk-free rate, which is the opportunity cost of money. And that should relate exactly to the risk that the company is taking. Okay? So the company's taking risk. There it is. It's the quantity of risk, and here's the price of risk. And so there's the amount of risk, and there's measured in the return. Now, alpha, or this abnormal return, is another way to describe it. Alpha is this term. So it means that you're getting an extra return given the same risk, but this is positive. That's what the goal of alpha investing is all about. Trying to find places up in this area. But you got to compare it. So if you're up here, you got to compare it to portfolios on this line if you're up here. So there's a huge literature, a huge following that talks about seeking alpha, seeking positive alpha, which means you have outperformed the market, you've beaten the market on a risk-adjusted basis. And that's the important point that you need to understand. It's on a risk-adjusted basis, because obviously if you take more risk in your way out here, you would expect to have more return. It's not a fair comparison. Okay, with this in mind, let's move on to the three forms of market efficiency and start to unpack this idea of what market efficiency represents. So let's talk about levels of market efficiency. There's basically three levels, and that's the first three bullets that I have on this slide. Three levels of market efficiency. And then we'll talk about the random walk hypothesis, which is not really a level of market efficiency. It's a concept that relates to market efficiency, which we'll talk about. But let's look at the first three bullets. These forms are levels of market efficiency. The first form is called the weak form. And the weak form says that all past stock price information, that means trends and patterns, are all baked into the stock price that you see today. It's already reflected in there. So if you spot a trend in a stock and you say, oh, I think I know where this stock is going, because you're looking at a trend, that's useless according to the weak form. And the question that you should ask yourself when you think you've found a pattern in the market is, what special information do you have that other investors don't? You mean to tell me that other investors haven't spotted that trend or pattern? You're the only one to spot it? You better think about that carefully, because the chances are somebody spotted that trend yesterday or the day before or the day before or the month before, a long time ago, before you've even seen it and recognized it. They got computer systems that are looking for trends every second. So my point is, if you believe and understand this market efficiency concept, or the point is, the market efficiency concept forces you to ask the question, what type of special information do you have that's not baked into the stock price today that you have and you can exploit it? That's a really good question. So to reiterate the weak form basically says past stock prices and patterns are already baked into the stock price. So you see a wiggly pattern, it looks like it's going to repeat, it's already built into the price. If you see an upward trend or a downward trend, it's already built into the price. Now let's move on to the semi-strong form. The semi-strong form says that all publicly available information is embedded in the stock price. So any information that's out there that's covered in the Wall Street Journal and filings with the Securities and Exchange Commission and advertising and press releases, all of that information, according to the semi-strong form, is baked in. So that if you, as an investor, have public information, it's of no value. You read something in the Wall Street Journal, it's been public for quite a while. Even a couple of hours is quite a while in this type of market, because what we find in the semi-strong form, actual research shows that stock prices adjust the new information really fast, for the most part. Not in every case, but for the most part. Stock prices reflect almost instantly, because there's people watching the market. There's thousands of people watching the market, waiting for new information. In a lot of cases, they know when the information is going to be released, but they don't know the direction of it. So they end up watching the market to see if they can trade on any new information that comes out. Let me show you graphically what we mean by the semi-strong form and the fact that new information, news, Not by the way, not news that you get on the news channel, because often by the time that's released, it's either been anticipated or it's stale. We're talking about truly new information coming to the market. So if new information comes to the market, here's how things should look. We basically have a stock price that's barely moving. There's no new information. That's what we're assuming here. This is P. This is time. And then suddenly there's an announcement at this point in time. And it's positive. The stock should adjust very quickly. And if there's no new information, the stock just keeps going on its way, relatively flat. That's an efficient market. Now, an inefficient market would be where information is very slow to get embedded in the stock prices. And it might look something like that, very slow. That slow movement would usually represent market efficiency, because stock prices are slow to reflect information, but it could actually, you can actually rationalize it in some cases to be an efficient market. And here's the explanation for that. In some cases, a good case would be, maybe it's a biotech company that's releasing information about a drug that's coming out. And, it's very, very risky. The drugs are complicated. You got to look at what the trials are doing, what phase they're in, what are the competition. And so companies will come out with press releases, and the market has to digest that information, process it, check, verify, and it may take time. So the information slowly comes about in the market as people try to piece together accurate information relating to the press release. Or it could be that there's a merger of two companies now, and that's just been announced. And normally you get a spike out of the stock market, but often you get returns drag on afterwards. In other words, the effect on the stock price carries for a period of time. And the reason for that is pretty simple. Mergers and acquisitions generally have to be reviewed by the Justice Department for antitrust issues. So, for example, you may have two banks, they decide to merge, but you have to wait until you get approval from the Justice Department and or the Federal Reserve, for example, because Federal Reserve monitors banks. And what they're going to look at is they're going to look at to see, well, what's the geographic footprint of each bank? Now, if those geographic footprints of each bank overlap significantly, that means, well, that new consolidated bank is likely to have a lot of market control and price control. In other words, maybe it can control interest rates and the cost of loans and interest rates that it pays on its deposits. And so to prevent a monopoly or monopolistic type competition, the regulators may ask the bank to sell off some of its branches in the places where they overlap, where the footprints overlap. So those are examples in cases where, information may be quite hard to try to parse out. Then you can have a slow-moving stock price in reaction to that new information. But by and large, most information that comes out, it gets embedded really quickly. And in theory, fully as that information comes out. Which is why you watch the stock market, you can see the stocks jump instantly on new information. And so that's the important point here. It has to be new information. If you've anticipated the information, it's not new information. Now, you may expect and know and realize that, look, the Fed is at 2 o'clock today is going to come out with a press release. Okay, that's right. It's going to be out at 2 o'clock. But is that press release going to be positive news or negative news? And what's the magnitude of that positive or negative news? That's random. And so new information that comes out is random, which makes it really hard to predict where the market's going. Because if you believe in market efficiency, prices reflect all available information. The only thing that's going to change a stock price is new information, which by definition is random. Because people out there try to anticipate the best they can. And if they're wrong, there's errors in their calculations. Well, that should be random. Now, let's move on to the strong form. The strong form is a bit too strong. Most people, most investors, people in the market would say that the weak form and semi-strong form are reasonable approximations to how the market operates. The market, nobody's saying, or very few people would say it's perfectly weak, perfectly semi-strong form. But most people will say it's reasonable approximation of how the market works. The strong form is almost unreasonable. Here's what I mean by what the strong form is. The strong form says that all information, not just publicly available information, is embedded in the stock price. That means people with inside information, it has no value. And we know that that's not right. If you're running a company, you have inside information about pending mergers and acquisitions or huge profits or losses that the company's realized, then you have information that you can trade on. That's really, really valuable. In fact, there's laws against that from trading on insider information because you can make a profit from it. So the strong form basically just completes the information set, and nobody really takes it too strongly, so to speak. So here's what I mean by the information sets out there. So we have the weak form. So the weak form has information, and I'll put a WF here. That's all past stock price information. That says, look, if you see a pattern like this, it doesn't mean it's going to keep going up. If you see a pattern like this, it doesn't mean it's going to keep going along, because that information is already embedded in the stock price at this moment. So that's the information content of weak form. Now, semi-strong form says all publicly available information. Well, that includes past stock price information and the returns that come about and volume of stock activity. So think of it as that concentric circle where we have semi-strong form. And then we have all information, which is the strong form. And that includes everything. So that's the way you can think about it as information sets. It's a really cool way to operationalize market efficiency, because when you talk about market efficiency, they say, oh, information is embedded in the stock prices. Well, how do you categorize information? How do you put it in a way that you can try to analyze it? Well, the weak form is fairly clear, past stock price information. Semi-strong form is pretty clear with publicly available information, and that publicly available information gets embedded in the stock price quickly. So it's a great way to operationalize the concept of market efficiency and actually test it. Now, let's talk about the random walk hypothesis. And let me clean up the slide a little bit. Let me summarize the random walk hypothesis like this. The random walk hypothesis says that stock returns that are generated from stock prices follow a random walk. And that means you don't know whether it's going to go up or down, when it's going to go up and down, and the magnitude of when it's going to go up and down. What's it? The return on the stock. So again, new information comes out. It comes out randomly. Okay, so if new information comes out randomly, you don't know the timing of much of it. And even if you know the timing of information that's coming out, you don't know the direction and the magnitude of it relative to the market's expectations. So that's important, relative to the market expectations, whether or not it's going to be new information, positive information, negative information. So the random walk hypothesis is saying, look, new information comes out randomly. You can't predict it. So based on that definition of the random walk hypothesis, it's not hard to see that the weak form and semi-strong forms are consistent with the random walk hypothesis. And that's because if stock prices fully reflect all available information, the only thing that's going to move a stock price is new information. And if that new information comes out randomly, like is consistent with the random walk hypothesis, which says, look, stock prices basically change in a random fashion, then it kind of all fits together. And so the random walk hypothesis is consistent with the weak form and semi-strong forms of market efficiency. Now, those are theoretical arguments. There's evidence against it and there's evidence for it, but most people tend to be leaning towards evidence that the markets are fairly efficient and it's kind of really hard to beat the market on a risk-adjusted basis. Now, with that said, there's been thousands and thousands of people and articles and research done to try to find ways to beat the market. Because if you can beat the market, you got yourself a money machine, basically. So there's lots of research in this area, tons of it. And so in that research, we've detected anomalies. Anomalies means we can't really explain why these patterns exist, but that's basically what it is. People have found patterns in the market, back testing, going back in time. Doesn't mean it's going to happen in the future, but they found patterns in the past. Now, let me show you. Let's go through some of these anomalies. The first anomaly is called the small firm effect, and the small firm effect was detected back in the early 1980s, and it basically said small stocks seem to outperform large company stocks, even on a risk-adjusted basis. And that's important because small stocks are obviously riskier than large stocks, so you would expect them to outperform the market. But even after you risk adjust, the small firms still tended to outperform the market. And what was interesting about that anomaly, and people couldn't explain it, why if the market's efficient, why would small stocks tend to be underpriced so that their expected returns that are earned are higher than what they should be? That's a good question. And so soon after this was announced, that this finding was announced, the small firm effect, most of it disappeared. In other words, people started buying small stocks, pushed their price up, and the expected return came down. It still surfaces at times. The small stock effect surfaces. It's mainly gone, but it comes back at times in different forms at different periods. And so you don't want to fully dismiss that small firm effect. Now, there's also a thing called the January effect, which is more consistent. The January effect says, look, the stocks in the first week and a half, maybe first 10 days of January, tend to outperform any other time of the year. And people have looked at this, and they've spotted it in other countries, not just in the U.S., but what it basically says is stocks do really well the first 10 days. And not only that, it often tends to be small stocks tend to perform really well in the first 10 days. So people have looked at tax issues, because what happens is people sell their losing stocks in December to get a tax deduction. And then they have proceeds that they reinvest in the first 10 days of January, and that pushes stock prices up. But, that kind of doesn't make sense in that, look, the Wall Street Journal has an article or two every year on that in December and January about the January effect. Everybody in the market knows the January effect. So why don't people just buy stocks in December when they're cheap, when people have been selling them for tax losses, and then sell them in early January and the price gets pumped up? That's a really good question. Why doesn't this, information about this effect negate itself? Why doesn't it just iron itself out? It doesn't happen, which is quite interesting. In effect, it happened with the small firm. The small firm effect basically, look, once people realized that the small firm effect existed, the effect disappeared. So why does the January effect disappear? That's a good question. There's no real good answers to that. That's why these are called anomalies. Now, there's also a day of the week effect that says Mondays tend to be poor. So we're looking at the returns from the close on Friday until the close on Monday, the following Monday. Those Monday returns tend to be negative, which means you don't want to be selling on Monday. You probably want to be buying on Monday. So what would you want to do? You'd want to buy on a Monday in December when people are selling for tax losses, and then sell in January on a Tuesday, Wednesday, Thursday, or Friday, or whatever day of the week seems good for you. That's an interesting strategy because you can compound these. You can pile these anomalies on each other, and that's what people try to do. Now, one other thing, with the smaller firm effect, there's also it's not just tax loss selling, but people think, people get a lot of bonus money. They get gift money in December, and then maybe that's what causes people to buy small stocks in January. both that tax loss selling, by the way, and that bonus money concept, it doesn't fully account for the January effect that we observe. Now, there's another effect called the PE effect, and the PE effect, that's a model for gauging whether stocks are growth or value and whether or not they're over or undervalued. The PE effect says that low PE stocks tend to outperform high PE stocks. That means the price for low PE stocks, that means the price is low relative to earnings. And low PE stocks are attractive, and they tend to outperform. And then high PE stocks means the price is really high relative to an annual earnings on the bottom of the fraction. And that, those stocks tend not to perform well. So that's an interesting thing because, look, everybody has PE ratios available to them. So go back to the concept of market efficiency, and do you have any special information? Do you have special information about the small firm effect, that firms are small? No, everybody knows which firms are small. What about the January effect? Everybody knows when January is. What about the day of the week? Everybody knows that. The PE, well, everybody can estimate in PE. They're everywhere. So why do these anomalies happen if all that information is out there? Well, that's why they're listed as anomalies. They kind of don't make sense. These patterns exist, but they're not in stone. Sometimes the January effect doesn't show up. Sometimes the small effect is gone for a decade. The day of week effect, hey, look, Mondays can be really strong on some days, and even high PEs can do really well. Now, that said, there's a common thread that might be buried in all these anomalies. So we've tested all these anomalies, and we've done risk adjustment for all of this. So when you look at small firms, well, of course, small firms are going to outperform because they're riskier, so you need to risk adjust. And if the January effect is related to small firms, well, even regardless, you got to consider risk when you look at the January effect, the day of the week effect, or especially the PE effect. Now, when you buy low PEs, the price is low relative to earnings. That could be because K, the discount rate, the required rate of return given the risk of the stock, has skyrocketed. The stock is really risky. That's what depressed the stock. So if you buy low PE stocks, you're loading up on highly risky stocks, which you would expect to outperform the market. So that's really important when you look at the PE effect and all these effects that you risk adjust. But the point is, even after we risk adjust, these effects happen. And that causes concern about, do we have the right measure of risk when we're evaluating risk? Nobody has the correct measure of risk on what drives the stock market. We use beta, we use standard deviation and variance, and there's other measures, lots of other measures of risk, but nobody says that encompasses all forms of risk. And so my point is, if we have a poor measure of risk and we're trying to do risk adjustments for all these stocks in these different events, then we could actually be contaminating the results. Because if we have a poor measure of risk, then we've risk adjusted things wrong, then maybe that's why we have these anomalies. We just don't know how to measure risk properly. Risk is really hard to pin down, and not only that, but risk is different from one investor to the next. Investors look at risk differently. So how do you sum it all up? How do you aggregate risk around a particular stock or the economy as a whole? Yeah, good questions. Now, the last anomaly we're going to cover is called the Dow Dogs. This is just one example of hundreds of different anomalies that people suspect that they're out. I shouldn't say hundreds, probably dozens of anomalies that people expect out there are found that occur, and then they kind of disappear and they come back again. Well, the Dow Dogs is interesting, and I just presented it as an example. The Dow Dogs says this: you buy it towards the end of the year, you buy the worst performing Dow stocks. Now, the Dow Jones Industrial Average is 30 blue chip industrial stocks. Nearly all of them are household names. You would recognize them. You've bought their products. Now, if one or two or three of those stocks have done really poorly in a given year, well, think of it. They're gigantic blue chip stocks. Okay, maybe they had a bad year. Maybe they had bad earnings. Maybe something happened. But they're likely to turn around because they're blue chip stocks that are household names. So the Dow Dogs says, well, buy those stocks at the end of the year, hold them for a period of time in the next year, and you'll outperform the market. So what do you think the problem with that strategy is? Well, it's that risk effect. If you buy Dow Dogs, you're probably buying stocks that are beaten down because of risk issues. And what you're doing is you're loading up on highly risky stocks with the Dow Dogs. If you don't risk adjust and carefully risk adjust your effects around these Dow Dog stocks, then you're going to have risk adjusted returns that don't really represent reality. So again, there is that risk problem. You need to risk adjust, and do you really have the correct measure of risk? Now, we're about to cover questions that you should ask a portfolio manager who claims to be able to beat the market. You got to remember that portfolio managers and people that manage money, it's their living. They got to somehow claim or make reasons for and justify their fees and expenses that they charge their customers. They're very, very crafty at telling you why they can outperform the market and why you should invest with them. Because if they didn't have a good story, nobody would invest with them and they wouldn't do very well. So before we get into that, let me give you an analogy that's really insightful, I think. It goes like this. Suppose you had a fair coin. Or suppose we had a fair coin. You know, heads 50% chance, tails 50% chance. You know what I'm talking about. And so if you start flipping coins, the pennies or these coins, and let's say heads are a 1, you get $1 or let's say $1 associated with the heads, and you get negative $1 for a tail. And so the average on a fair coin would be, look, you'd get some dollars, you'd lose some dollars, you'd break even at 0. Now that there's going to be some people who flip coins. Let's just assume that, like investors, there's thousands and thousands of investors, there's thousands and thousands of coin flippers, and they're flipping coins all of the time. Just continuous. Well, there's going to be a few people that flip heads consistently for a large number of times. They're going to be way out in terms of the amount of money they've accumulated, way, way out there. And then there's going to be other people that have performed really poorly. In other words, they've lost $1 on every flip, and they lost tons and tons of money. Now, the average flipper should have probably broke even or thereabouts, close to it, because it's a normal distribution, a Bell distribution wrapped around 0. So that kind of makes sense. Now, if you apply this to the stock market, there's going to be people, even if the market is completely random like a coin flip, there's going to be people that are making buy decisions that just happen to make a really good bunch of buy decisions in a row, and their portfolios have done really, really well over the past couple of years. And what do you think those people are going to tell you? They're going to tell you, and they're going to market themselves as having, the secret recipe on investing. They got this model, they have this information that nobody has, and they have the secret sauce to be able to make a really good profit. Even though that if stocks are perfectly random, it's like the coin flipping example, it had to be random. So the coin flippers are going to tell you, look, I got this secret flip. I can flip this coin in such a way that it comes up heads most of the times. That's what they're going to tell you and argue. And so you need to take that into consideration when you hear people telling you they can outperform the market. Now, on the other side, the people who have done really poorly, they're just going to tell you, well, it was just bad luck. And that's right. It was bad luck because the coin was 50-50. So be wary of people out there in the market trying to tell you that they can outperform the market. Because there's always going to be people that outperform the market, even on a risk-adjusted basis, by happen chance, randomness. Now, to try to better inform you about what to do when you meet these people, the people that tell you they can outperform the market, there's a series of questions you should ask. And it's my experience that once you start asking these questions, the whole story that people have, these portfolio managers, about how they can beat the market, their whole story falls apart and they don't have answers. So what are these questions? Let me show you. So let's go down the list that I have here. It says the first question is, how do you make buy and sell decisions? So what often happens is you talk to a broker or portfolio manager who works in a small office to a large financial institution. The large financial institutions based in Chicago, New York, London, somewhere. And basically these people that are local will tell you, well, we have a headquarters and we have a whole research department dedicated to finding undervalued stocks and outperforming the market. And right there, you should be suspicious because they're throwing off the answer. They don't have an answer for you. So they're throwing it off and saying, look, we got this gigantic department. Well, many of the big financial institutions have gigantic departments. And there's no indication that just because they have these big departments, that they're outperforming the market. For example, if you look at the mutual fund track record, this is really interesting. You got to ask the question, well, mutual funds have professional portfolio managers. Do they beat the market on average? And the answer is no, they don't beat the market. And especially by the way, once you deduct out the expenses, the cost of managing the portfolio, they tend not to outperform the market. They may match the market for indexing or come very, very close. And the active investors at times can beat the market, but a lot of times they don't. And on average, they tend to underperform the market. These are professional portfolio managers. So keep that in mind, that even in the mutual fund world, the professional portfolio managers tend on average not to beat the market. Now, there's always exceptions to that rule, but by and large, they tend to underperform. And so, by the way, people who do outperform the market, you can never really tell if it's true skill or it's randomness. So go back to the coin flipping example. If you have somebody in the stock market who's flipped a whole bunch of stocks over 20 years and has done really, really well, can you distinguish whether it was skill or whether it was luck? Because the coin flipping example is going to tell you, well, there's always going to be a few people way out on that tail because they just happen to flip a bunch of heads. And in the stock market, even if the market's truly random, there's going to be a bunch of people that have done really, really well. The question is, was it skill or was it luck? And the answer is, you never can tell. And that's why you got to be a little leery because you don't know if those results are going to continue. The world of finance and Wall Street is filled with people over the years who have had hot hand. They're called hot hands, who've done really well for periods of time. And then after that, things just fall apart. And that's randomness. So there'll be people that get interviewed 24/7 on CNBC, and they're watched on the Wall Street Journal and Bloomberg. And then after a while, they miss some calls, they miss some predictions, and whatever skill they had or whatever pattern that they were finding that worked for them disappeared. So the point is, in hindsight, they may look really good, but you really don't know what's going to happen in the future. So now let's go back to the questions here. What is special about your model, the information you're using? And that goes back to the question of if they defer to the headquarters and they got their research department, they really don't know. Then the next question is, what is your benchmark? And that's really, really important because you need to have a benchmark that's comparable to the portfolios you're managing. You don't want to compare a bond portfolio that you're managing to a stock portfolio. Imagine this. You manage a bond portfolio. Let's say it's money markets, for example. Money markets they don't move. They keep $1 price and they earn a small return every day. We know that. But in a really bad recession, the stock market plummets. And you would expect and you would see high negative returns going on in the stock market. And then if you try to compare yourself as a money market fund to that stock market, well, of course you're going to outperform the market in that time period. That makes sense, but in the long run, is that the case? You should not be comparing apples to oranges. So if you manage a portfolio of value stocks, for example, you should be comparing yourself to a benchmark index of value stocks. If you manage growth stocks, you should be comparing yourself to growth stock indexes. It's got to be comparable. And you need to ask the question, well, what is your benchmark? Again, things start to fall apart with some of these portfolio managers when you ask them that question. Then the question is, well, even if it is, even if you manage value and you're comparing it to a value index, are the constituents the same, roughly the same, and what are the weights? And so you should be aware of the weights that are in the index versus what's in the portfolio manager's portfolio itself. And then the question is, does the benchmark that the portfolio manager is using, does that reflect the total return? Does it reflect the cash flow? Because many index returns that show up are just the price component. They ignore the dividend component. Well, the dividend component could be substantial, especially over time. So keep that in mind. You got to look very closely at the benchmark that people use to compare their portfolios to. And then the next question you should ask are all your portfolios included in the data you're referring to? So you got a portfolio manager may manage maybe 100 portfolios for individuals and firms. And so the question is, are you showing all your portfolios? Because some of them will just cherry pick their portfolios. Not only that, but they'll cherry pick their portfolios at specific times. And they'll show you for a very short period of time, well, look, I beat the market in this year. Well, at any given year, given the randomness of the market, you can outperform the market significantly any given year. But what have you done consistently over the long term? That's a really, really important question in this area. It's what have you done in the long run, because you can iron out the randomness a bit by looking at things over the long run. And the other thing you need to be really, really careful of, and that is the idea of survivorship bias. Survivorship bias works like this. You're a portfolio manager, you have 100 clients right now at this point, and then you disclose, well, look, here's my performance for these 100 clients. It's really good. It's outperformed the market on a risk-adjusted basis. Look, but what's not there is the fact that over the last 10 years, this portfolio manager may have lost 50 clients because of underperformance, and those clients moved on to another portfolio manager. Well, that information is not embedded in the information the portfolio manager is giving you right now, because the portfolio manager is only showing you survivors. In other words, customers that survived him or her. So it's really, really important to take that into consideration, the concept of survivorship bias. It's really important when it comes to the mutual fund world. And so I can tell you this from experience, having worked in the mutual fund business for a while, doing auditing. It works like this. So you look at a mutual fund complex, they may be managing 100 different portfolios, 100 different mutual funds. And they'll tell you, look, here's our results for these 100 funds. On an average, we're beating the market. And then, okay, you're beating the market as of now based on the funds that you're managing right now. But what about those dozen funds over the last 10 years that you scrapped and you gave up on because they underperformed, and you merged them in with other funds and so on, and you gave people their money back? That happens. So here's what happens in the mutual fund world. It's called incubating funds. You got a mutual fund sponsor company that manages 100 or more mutual funds. On any given year, they start up a half a dozen new funds, brand new funds they start up. And the funds that do really well, they keep. And maybe 4 of them don't do very well. They close them fairly quickly. And so they keep the survivors. And they keep doing that, keeping the survivors, and anything that doesn't do well, they eventually close. Well, there you got survivorship bias. And there you got literally the incubation of funds and portfolios and only keeping the survivors. So when you do mutual fund studies, or you do a study of anybody who has managed money over a long period of time, you need to look at the clients that disappeared, that moved away, or the portfolios that have collapsed and have done poorly. That all needs to be included in the data to see if somebody's outperformed the market. And then again, at the bottom here, what time period is covered by your returns? That's really important. You don't want to have cherry picking, so you don't want to have people giving you returns for a short period of time. Even a couple of years is a short period of time. You need to look at long-term, like 10 years or more performance, to get an understanding of how this portfolio manager or managers are working and performing. So before I wrap up this video, I have an interesting question to ask. I've been telling you so far that the market appears to be reasonably efficient in the weak form and the semi-strong form, and it's very tough to beat the market. Well, if that's the case, then why are there so many people and institutions trying to beat the market? They're spending millions with a research staff at hand looking for stocks that are undervalued. How can that be if they're not going to find anything? Well, it turns out that the market is informationally efficient in the sense that if a firm spends $10 million on research, say, and they have $1 billion under management, that's 1% of $1 billion. Then what we find is that that company, that institution, will generate 1% extra return on their portfolio, just enough to cover their expenses. That's what it means for a market to be informationally efficient. Now think about it. You found a pattern, you found a trend, you found a PE stock that looks low. How much did it cost you?